The One Big Beautiful Bill Act, signed July 4th, 2025, increased the SALT state and local tax deduction. Are you leaving money on the table? Here's what you need to know about the new SALT deduction rules in 2025. SALT. We're not just talking about margaritas. The One Big Beautiful Bill Act, signed into law on July 4th, 2025, includes one of the largest tax changes since the Tax Cut and Jobs Act, and planning is essential for this one. Today we'll break down the SALT state and local tax deduction, how it works, who qualifies, and how smart planning can save you thousands. Because this is something every taxpayer needs to understand, we here at Uhart Tax and Financial help our clients and family navigate with confidence and clarity. And remember, be sure to like and subscribe our videos so you don't miss out on any tax tips or words of wisdoms that can help you achieve financial success. Now let's get started. SALT, or state and local taxes, is an itemized deduction on the Schedule A form. And prior to 2017, these taxes were largely deductible, but the Tax Cut and Jobs Act capped those deductions at $10,000 for joint filers and $5,000 if you were filing separate, impacting taxpayers in high tax states like California and New York. The One Big Beautiful Bill Act temporarily increases the cap to $40,000 starting in 2025, and from 26 to 29, that cap will increase 1% per year, and then revert back to $10,000 in the year 2030. So in 2026, it'll be $40,400 and so on. Here's where tax planning is essential. The income threshold is a cliff. It is not a phase out like many deductions and credits. So the full $40,000 deduction is only available to single, head of household, and joint filers with a modified adjusted gross income at or below $500,000. Married filing separate filers must be at or below $250,000. If you earn just $1 over those limits, you fall off the cliff, and your deduction reverts back to its original cap of $10,000 or $5,000 if you're separate. There is no phase out. So again, proactive tax planning is essential. This means a couple earning $450,000 qualifies for the full $40,000 deduction. But if their income rises to $550,000, they only get $10,000, a $30,000 deduction loss. And while pass-through entity tax elections remain an option for business owners, individuals with income limits should consult a tax professional to explore. Income restructuring, such as deferring income or increasing pre-tax retirement contributions, married filing separate elections, even in a community property state where income and deductions are divided equally between spouses. And although complex and a higher tax preparation fee, it can still offer significant tax savings when planned and handled correctly. To maximize your SALT benefit throughout the years, you can do something called a staggering approach. And through a strategic projection planning, you can bunch deductions in alternating years, maximizing itemization when beneficial, taking the standard deduction when it's higher. An example of this would be in a high deduction year, you could do maybe 13 tax payments instead of 12, or 2 years of bunched contributions to charities, maybe an extra mortgage payment that applies to the interest, vehicle registration renewals if you can time them towards the end of the year or the beginning of the year. Low deduction years, you would take less deductions by making less tax payments, less charitable contributions, and just take the standard deduction. Some other increases to state taxes is prepay your January estimated taxes in December rather than that January due date. Time your major purchases with deductible components such as home purchasing. Meet Fred and Wilma, California couple. Fred earns $254,000 and files separately. Wilma earns $146,000 and qualifies as head of household since she has a college-age child. Fred has $20,000 in state and local taxes, and Wilma has just $15,000. Now, under the old rules, their SALT deduction was capped at $15,000 combined, $10,000 and $5,000. Under the One Big Beautiful Bill Act, Fred was over the income cap. He made more than the $250,000 allowed, only allowing a $5,000 in a SALT deduction, and Wilma was able to claim $5,000 more for her full $15,000. With tax planning strategies, we ask ourselves, Can we reduce Fred's income to be underneath that threshold? And the answer is yes. Since Fred is under $250,000, by us increasing his retirement contributions of $16,000, he resulted himself in a $13,000 refund because he's allowed to take the full $20,000 as a married filing separate SALT limitation. As we look at this chart, we see he's now gone from $22,000 in itemized deductions to $37,000. Again, resulting in about a $13,000 refund rather than his $400 in the year previous. We essentially released that $13,000 to free up in his withholding to allow him to contribute almost with nothing out of pocket to his retirement account. Without strategic guidance from a tax professional, they would have lost out on these valuable benefits. They would have thought their income just didn't qualify them, but tax planning changed that. And don't wait until after tax season when you find out that you missed out on something you could have planned for. Tax planning isn't a one and done task. It is something that should be done year round. You need to actively monitor your incomes, deductions, life events. That proactive planning gives you the ability to adjust your withholdings, shift the timing of income, and take advantage of strategies that can dramatically reduce your tax bill. So don't leave money on the table. Plan ahead, stay informed, and give yourself the best shot at financial success. Proactive tax planning is worth the investment. It's best to have multiple check-ins during the year as things change. The SALT deduction cliff has no grace period. If you're over $500,000 joint or $250,000 as a married filing separate, your deduction is going to drop back down to that $10,000 or $5,000 limit. There's no phase out, no forgiveness. Just $1 over and you can lose tens of thousands in a deduction, resulting in thousands in tax. And don't forget, the SALT reverts back to 10,000 limits in 2030. So it's essential to plan not only now, but each year going forward until that change happens. You need to calculate and know what your 2025 projected modified adjusted gross income is. And modified adjusted gross income changes for different aspects that we're looking for. Based on SALT, it's a different one than if you're calculating for your IRMA, which is your Medicare premiums. Consult a professional to help you figure that number. Next, review current withholdings and retirement contributions. Again, by maxing out, you could be saving in taxable income, allowing you to make changes to your withholding and not come out of pocket from these plans. Schedule that planning session before year end with a tax professional and consider filing status optimization. The sooner you start your plan, the better the outcome. The more time you have to make some changes that could impact your taxes dramatically. Thanks for learning about how the SALT limitations under the new One Big Beautiful Bill Act impact your taxes. As a reminder, this presentation is educational purposes. It does not guarantee outcomes or provide specific tax advice. It's recommended to reach out to a professional about your specific tax situation. Have a great day, enjoy your drink, and achieve financial success.